Me, Oluya Geolayemi Akinola. Let's talk about the X curve concept. When you're building wealth, you need to build it with responsibility. So we'll be talking about X curve. What is X curve? What is wealth curve? We're going to be asking ourselves some questions today. The X curve concept is a simple way to show the relationship between taking care of your own responsibility and building your wealth. The concept takes into consideration when you are younger, and then we believe that as you grow older, then you can be building the wealth. So it means that when you are much younger, you have a lot of responsibilities that you have to deal with, and it also shows the time that people are generally less secure, and then they start building the wealth into the future. And the more they grow older, then they start feeling a bit secured, financially secured, and that's also involve the law of building wealth. So talking about the X curve, it's like this X shape curve. It involves two curves, and that this runs at opposite direction throughout one's lifetime. So the wealth curve now, when you're younger, you have more responsibilities, you don't have much money, then you start to save and invest, you build up your wealth, right? And then the wealth curve rises. Hopefully when you get older, you have enough money for your retirement, then the wealth curve is your investment curve. Does that make sense? I want to believe that it does. So it means that at the base of the hex, like this, the base, you are younger, and then you are building up your wealth, and then you are going towards retirement, and that means you are growing older. So you have to start to save and invest when you are younger, and then you grow it until you get older. Then the responsibility curve, that's the opposite one. When you are younger, you start a new family, you have higher responsibilities for children, mortgage, college planning, debt, loans, and all that. So at that point, you need insurance. You need because of your high responsibility. So the level, the amount of insurance, the amount of coverage that you have, would also matter to you at that point. And then this starts reducing over time, because as you grow older, you don't need much insurance again, you understand? So in terms of responsibility curve, it's like the other way around. It goes from up, you need very high insurance, and then it goes down to less responsibility. And at the time you're having less responsibility, you're already getting older, you don't really need much insurance coverage at that point. So you and your spouse are responsible for all these obligations. Whether you are alive or you are dead, you are both responsible. Earlier on, the need for insurance protection is quite high. And like I said earlier, the more you then grow up, the need starts coming down, because the mortgage would have reduced by that time. The children would have grown up. You have reduced your debt. You have paid some of your mortgages and all that. So more wealth, more responsibility. You understand? So that's how those X curve works. Assuming you have two kids, if something happens to you, your spouse may not be able to take care of them. Factoring in your standard of living, your debt, your saving plans, you have to figure out the need for protection at that point in time. So let's say you have two kids, you're thinking about $500,000 worth of life protection. With that coverage, your spouse will be able to have enough income, to raise the children in case you are gone. That's the essence of, coverage that you must understand. However, let's say you are a good saver, you build up your wealth rapidly. When you have $1,000 saved, you may not need $5,000 worth of insurance. At that point, you only need like 400,000, because if something happens, your spouse will have 100,000 savings plus $400,000 worth of insurance, totaling 500,000 to care for all the needs around. So when you save $300,000, your protection needs drops to about $200,000. And of course, when you reach $500,000 of savings or investments on hand, you will no longer have the need for protection. So that's how the X curve actually works. So let's say $500,000 worth of life insurance. The more you start, growing your wealth, then the responsibility starts going down till you no longer need this protection. And then when you start saving and you start investing, start growing, at the point they will meet at the middle, and then your savings and your investments would also increase, such as when you have enough savings and investment, you may not even need any form of protection at that point in time. So let's apply this principle to your home. When you buy a house, your friend will come to the housewarming, they will congratulate you as a new home owner, but actually you don't own the house, because you already have a mortgage on the house. The bank lender actually does own that house, if we want to tell ourselves the truth. So you own the mortgage, which is your responsibility. Until you pay for it, you don't own the home. This is the bitter truth that you know and everybody knows. Assume your mortgage is $300,000 for 30 years. Most of your payments in the early year will go into the, interest payments. And then a little will go into the principal of the loan. And when this happens, assume that you understand the X curve and all that. You decide to pay more than the monthly payment in order to accelerate contributions to the principal of the loan. What happens? The faster you do that, the sooner you'll be able to reduce the mortgage balance, and then you can own your home sooner than scheduled. So when you know this principle, it will help you to be able to balance the X curve, because the mortgage is 300,000, we are assuming that, and then the more you start paying it, then it starts going till it becomes $0. So it depends on how you want to accelerate your payments, that it will, reduce all the liabilities that surrounds owing that mortgage. So the X curve provide a clear approach, for building your financial foundation. You'll be motivated to save, invest, accumulate your asset faster, so you can reduce your debt, your mortgage, your liabilities very soon. So you focus on college funding and retirement, fulfilling your responsibilities, and reducing your insurance need. That's what the X curve would do for you. In life, two outcomes can happen to you: either you live too long or you die too soon. In any event, you should protect yourself and your family's future. Number one, have a high protection when you are younger. It will take care of your family, your children, everything that is associated with you: college education, mortgage, debt, if something happens to you. Then number two, save as much as you can to take care of your future. You have to be cautious. There are a growing number of people who have more debt as they get older. Instead of reducing their mortgage, many people buy bigger houses and take on bigger mortgages. And of course, some may have more children if they remarry. As a result, they may still have high responsibility, and then definitely there will be now need for high protection needs. So by understanding the X curve concept, you may want to decrease your responsibilities and increase your savings to move toward a debt-free, happier life. And honestly, believe me, when you study the X curve, life will be simple. It's not too complicated. X curve for the responsible. The true meaning behind the X curve is responsibility. If people are not responsible, the concept is of no benefit. There are people who spend hundreds of dollars a month drinking, partying, gyrating, gambling, but they have no insurance. They have no protection. Others shop until they drop on plastic money. Parents spoil their kids with toys, lavish birthday, yet they save nothing into their college funding. Their popularity and their image to their friends take a higher priority, than the future of their family. The person with responsibility knows that where his or her priorities is their family financial future. You must know what you want and what you need. You have a clear goal and a plan to achieve it. So quite often, the person who doesn't care about the protection for the family also doesn't worry about saving for a rainy day. They don't care about emergency fund or whatever. If they die too soon, their family will suffer. And if they live too long, many become a burden to their children, to their family. But for the people who care for their family, if they die too soon, they will have enough insurance protection for their loved ones. They also believe in saving for their children's college education. And if they live too long, they also have enough savings to care for themselves in the later years. So this is a win-win approach if you ask me. So without responsibility, there is no insurance need and no saving, and therefore there is no X curve. I hope I've been able to explain what X curve really means to you and the responsibility that comes with X curve. I remain your loyal girl, Olayemi Akinola. Stay tuned to my channel till we meet next time. Let's keep winning always. Thank you and God bless.